How stable is Costa Rica's currency? How stable is Costa Rica's currency? This question is important for anyone interested in the economy of this beautiful Central American country. The currency in question is the Costa Rican colón. This currency has shown moderate stability but faces challenges typical of an emerging economy. The Central Bank of Costa Rica manages the colón under a floating exchange rate system. This means that while market forces play a significant role, the central bank intervenes when necessary to maintain stability and control inflation. As we look at the current situation in early 2025, the colón has experienced some volatility. This is influenced by both domestic and international factors. On the domestic front, slower economic growth in sectors like construction, commerce, and vehicle sales has weakened the overall economic momentum. When economic growth slows, it can lead to reduced foreign investment and less availability of U.S. dollars. This situation can put upward pressure on the exchange rate, meaning the colón may depreciate against the U.S. dollar. Job losses and reduced consumer spending also contribute to the strain on the currency's stability. Externally, Costa Rica's heavy reliance on imports and exposure to global commodity prices, especially fuel, affects the trade balance. Changes in U.S. trade policy can introduce uncertainties that may impact dollar inflows. Since the U.S. dollar is the main foreign currency counterpart to the colón, any fluctuations in its strength can have a direct effect. Despite these challenges, the colón has shown relative strength recently. The exchange rate has been around 500 colóns per dollar, which is a slight appreciation compared to previous years. This stability can be attributed in part to Costa Rica's thriving tourism sector, which generates significant dollar inflows during peak seasons. However, fluctuations in tourist numbers and export difficulties can still lead to short-term volatility. From a capitalist perspective, the stability of Costa Rica's currency reflects the balance between market dynamics and government policy. The managed float system allows market forces to guide the exchange rate while enabling intervention to prevent excessive volatility. This balance is vital for an emerging economy like Costa Rica, where maintaining currency stability supports trade and attracts foreign investment. For businesses and investors in Costa Rica, monitoring economic indicators and policy shifts is essential. Currency fluctuations can impact import costs, export competitiveness, and overall profitability. For consumers and tourists, changes in the exchange rate affect purchasing power and the cost of goods and services. In summary, Costa Rica's currency stability is moderate, shaped by internal economic performance and external global influences. The approach of combining market mechanisms with strategic intervention aims to maintain this stability, which is essential for the country's continued economic growth and integration into global markets.